Good evening, sir. Okay. Please, Kalu, can you hear me? Taiwo, can you hear me, please? Okay. You can shut me up. Hear me, please. Yeah. Faintly. Oh, okay. Good evening, please. Taiwo, can you hear me very well now? Okay, okay, okay. Thank you. Now, sorry for coming a bit late today. 5 minutes late. Sorry, and in the middle of the lecture, I sent a note to you, but unfortunately, I realized that, we had a communication breakdown at a point that they have actually taken a mining taxations with you. Yeah, so I will have to interject the lecture. I mean, when it gets to the middle of maybe 1 hour time, I have to upload the other part of the lecture I was unable to send because I have to do that so late. So I'm expecting to send it in, then I'll forward it to you. I'm going to use that as, for insurance. So let's talk about transportation of shipping or transportation or courier companies. So let's look at that taxations now. How do they tax this kind of company? Okay, the network is bad. Okay, so can you hear now? Start. Oh, okay,
Please restart the network, sir.
okay, okay. Thank you. Okay. Sorry, give me like 2, 3 minutes. Let me restart the network so that because of the network issue, let me do that again, please. Sorry. Come in. Can you hear me very well, sir? Can you hear me, sir?
Yes, continue, sir.
Okay. Let me, please, let me, I'm coming. I'm trying to share my screen now. Uh, good evening. So I believe that we are all listening or hearing me. So we are. Let's quickly look at taxation of shipping, air transportation. Now, we see these are foreign companies involved in the business of shipping, air transportation, and courier. The way they tax these companies, the company that are involved in what's in oh, my network is unstable. I pray it should be okay. My network today. So okay. Now, those companies are a foreign company that are involved in shipping business. They are also involved in air transportations and also involved in goods from one country to another. How do we tax them in our region, in our country, in our country, knowing fully well that their operations is not only carried on in Nigeria, it's also carried on in other territories. So that simply means that for the way they tax all these shipping companies, foreign shipping companies, it's also the same thing they tax was air transportations, those people that aircraft and so on, and also all the foreign courier companies. The way they tax them are similar. I guess in the way they tax them, they have a similarity in the way they determine their tax liability. Knowing fully well that this topic is what we are doing is division class. Let me just quickly put all through. So what we need to know, then we'll just take a question and resolve it and we'll split. Now, if they say a company that a foreign company that involved in shipping, air transport and courier companies, how do we determine their tax liability? The first thing you need to know, you just first need to know their global income. That's the first thing we need to know. What's their global income? And when I say global income, that simply means that that's the income they make right in Nigeria and outside Nigeria. It means that if you have Ethiopia Airlines that is operating in Nigeria, US, UAE, and so on, you realize that all the income it makes in Nigeria and other countries in which they operate, if you add everything together, that is of the income of the company in the world, including Nigeria. So the first thing to determine global income. Now the next one is Nigeria income. That's the what? That's the income they make from all the activities from what that are moving from Nigeria to the other country. Let's say, for instance, shipping. If they are moving goods and items from Nigeria to other countries, whatever they make is what will be termed as the Nigeria income. If it's aircraft, if they are moving goods and even human beings from Nigeria to outside the country, outside Nigeria, the income they make can be termed as what? As a Nigeria income. Global income is income they make all over, inclusive of that in Nigeria. But Nigeria own is what they want to make in Nigeria from Nigeria to outside what? Outside Nigeria. Now the third thing is what? Depreciation ratio. This is the ratio of the depreciation in the company's account to the global income. Now, if you look at the global account of the company, the company's profit statement, you realize that there will be depreciation in it. Now, that depreciation, what is the proportion of that depreciation to their global income? You already know what their global income is, so be the income they make all over the world, including Nigeria. And we want to subject this company to Nigerian tax. That's why we are doing all this. Now, after you have done their global income, you have done the Nigerian income, the next thing is to know what? their depreciation income. And when we say depreciation income, what do you mean by depreciation income? That's the proportion of the depreciation charged by that company globally now over the what? The global income. So if you find that percentage, you just multiply it by 100. Well, get your it's a depreciation rate. Don't forget, see as something, the tax liability of this company to Nigerian government. So we need this ratio, depreciation ratio, to determine that tax liability. That's depreciation over what? Over global income. The next one is what? The next ratio you need to get is what? Adjusted profit ratio. And when I say adjusted profit ratio, what do I mean by adjusted profit ratios? I mean the proportion of the adjusted profit of the company. Profit. That means that once the profit declared by the company worldwide, you need to now adjust that profit by for a liability or disallowability of expenses. You know, there are some expenses that what they would have allowed that have to be disallowed, like depreciation, like preliminary expenses, like acquisition of current, non-current assets, and so on. All these are not supposed to be expense, but if they have been expense, adjust the organization. What we get is the adjusted profit. You see that adjusted profit now gets the global income that we got in this first point here. If you divide it, you now have what we call adjusted profit what? Profit ratio. That's what adjusted profit ratio is now adjusted profit over the global income times 100 over 1. You see, these are the two ratios you will need in the exam. Please don't overlook this topic. In the last syllable, they set it 3 times. Why they refuse to set insurance for one time at all? They didn't even set insurance, and the two topics are under the same special business. And they call it special business, you know. So please, it means that the examiners are always happy setting this type of questions. Now, the adjusted profit ratio. This is the ratio of the adjusted profit to the what? To the global income. That means that you are going to divide the adjusted profit over the what? Over the global income, you get the ratio. These are the two ratios you need to compute the what? The taxability of the Nigerian government. Now, after getting the two ratios, look at how you now use the two ratios in the exam. Look at it. You now say format of determination of what? Of tax liability of the company to Nigerian government now. Now, you now get what is your Nigerian profits. How do you get your Nigerian profits? You know, in this place, you know, we got our Nigerian income to be all the income derivable for a company from all its activities moving from Nigeria to the outside country, to the outside the world. It is the shipping. All the goods they moved, the income they got from all the goods they moved from Nigeria to outside Nigeria. If it is airline, all the load they carry, I guess what I'm saying now, from Nigeria to outside Nigeria, that is what their Nigerian income. If it is all the goods they moved from Nigeria, the income they make from Nigeria outside Nigeria, you also that's what Nigerian income. Now that Nigerian income, now if you're able to identify it, what do? You now multiply it by the adjusted profit ratio. This is the form. You know, we are posting a ratio here. You now multiply the adjusted profit ratio by the what? By the Nigerian income. What do you get if you do that? You are going to get the Nigerian profit. That's what they did here. The profit in Nigeria can only be determined by what? By multiplying the adjusted profit ratio. Yeah, by multiplying adjusted profit ratio. This let's kindly disable the video. My host, please. Thank you. The Nigerian profit now. So get the Nigerian profit, it is now the adjusted profit times the Nigerian income. So you get the adjusted profit, Nigerian profit. Now to now get the capital allowance that will be deducted for the that is taxable in Nigeria. How do you get the capital allowance? You now say that depreciation ratio you got initially, You know, you got the depreciation ratio by saying depreciation ratio now is Nigerian income. Whatever you get is your what? Is a capital they are going to use in Nigeria. That simply means that for Nigerian territory, the profit that is taxable in Nigeria, the profit that is going to be taxable in Nigeria is what is this? The capital allowance that are going to is this. If you move office, that's when you now subject the what? To tax liability in Nigeria. Now, company income tax at 30% of total profit. So company income tax at 30% of total profit, though in the new bill now, that is how they graduate it, they say big company, medium company, and all that. But based on the formations that we have in the past, so to say, we'll still to what will keep you at new developments in what's in the new bill, because we don't know, because this is exactly so, and as a match exam, they of testing the word the tax the new tax don't test it, but they now come in what in testing what exactly are the new content of that, and that simply means that we need to keep ourselves abreast of what is in that bill, at least to an extent, so that whatever they set in the exam, if ICANN refuse to give a position on the usage of that tax, the new tax information, then you should keep yourself abreast of this, what they have in their pack, and also what we have in the what in the new bill, so that at the end of the day, we'll do this exam and what and we'll say. So, based on the information supplied by ICANN, the company income tax at 30% of total profits will be the tax liability, while the education tax will be 2% of the wealth of the profit before the capital allowance. That's the what? That's the date. The minimum tax is 2% of Nigerian income. Now, as far as this is concerned, the law under this kind of companies is determined by saying 2% of the income they made in Nigeria. Now, if you compute the 2% of the income made in Nigeria, and that if the 2% is more than the 30% of the total profit, then the tax liability will be what? Will be 2%. That 2%. It means that the higher of 2% of Nigerian income or the 30% of total profit, that's what's payable in tax in Nigeria, the Nigerian government. Now, please note that. Now, note the following. The higher of the tax is as computed, and the minimum tax of 2% of Nigerian income shall be payable to Nigerian authority. I explained that. The two ratios, that is adjusted profit ratio and the depreciation ratio, must be rectified by Nigerian tax authority as okay. This must be certified. CERTIFIED must be certified. Sorry for the mistake, for the certified by Nigerian tax authority to be what? As okay. It means that they have to ratify that two ratios, that is okay. It means that there must be a consensus between the Nigerian government and other countries' governments. I mean, where companies decide. I mean, as far as the two ratios are concerned. Now, but if the tax authority are not satisfied, assuming the tax authority is now not satisfied with those two ratios, the profit deemed to be derived from Nigeria may be computed on a fair percentage on the full sum recoverable in respect of the carriage of what of the passenger etc. shipped or loaded in Nigeria. That means that if those ratios and the capital and the deposit are not certified or ratified by the tax authority in Nigeria, then the tax authority in Nigeria will apply a fair percentage. Now, what is not fair is not a relative term now. Down to their own discretion now. They will apply a fair percentage. Look at it. They will apply a fair percentage on the full sum receivable in respect of the carriage of passenger in Nigeria. That means that to know how much to be taxable in the hand of that company, in the situation where the tax authority is not really satisfied with those two ratios, what they will apply a fair percentage to the Nigerian income. That's the income they make from all the loadings they make from Nigeria to outside the world. I hope you get what I'm saying now. When this occurs, the company has within 6 years to claim that its liability will be computed on the basis of the ratio referred to as above. It means that if Nigerian Tax Authority now use that fair approach, that is when they are not really in tune with the two ratios, then it means that that company is having that privilege of 6 years from that year of when they computed to apply to the FRS, telling them that what they should revert that computations to use the normal ratio, to convince them. They have 6 years to convince them that they should what? They should reverse the way they computed it, that's using the fair approach to what? To using the ratios. Apart from that, after that 6 years, it will not be acceptable again. That liability will be what? That tax computation will be deemed to be what? To be final. Now, that's what we need to know under the taxation of airline. I hope you understand what I'm saying. Now, let's look at this. I told you in the exam, if peradventure the exam actually come with in terms of shipping, the same approach. Airline, the same approach. If it is Korea, the same. Even if it is telecommunication, maybe I didn't put it there. If it is telecommunication, you'll be looking at, if it's telecommunication, the Nigerian income will be all the calls that move from Nigeria to the outside Nigeria. If it is global income will be all the income they receive from all the calls they make from Nigeria to outside Nigeria, and all the income they receive plus all the income they receive from outside Nigeria to Nigeria. That will give their global income. But Nigerian income will now be income from all the calls they make from Nigeria to outside the country. If it is shipping, if it is Nigerian income for shipping, all the income they receive from all the ship loading into the ship from Nigeria to the outside Nigeria. Why this global income? Both that Nigerian income plus all the income they receive from all the loading from outside Nigeria to Nigeria. The same thing applies to airline, and the same thing applies to Korea. So you should not want to bring the exam. Know that the same ratio. What are the ways? These are the ways that are identified. Yeah. Now let's look at it. The question. The passport. Chief Bonnie Shipazam is the chairman CEO of Shizara Group of Companies. The conglomerate operates in several states of Nigeria. The group's areas of business interest spans across supply of building materials, transport, and banking. In 2012, at the instance of the chairman, the group decided to diversify what is business into some African countries by floating Obi Airlines Limited, which was incorporated. Obi Airlines Limited that is incorporated in Ethiopia. On May 25, 2016, as Chief Shipazam was in the executive lounge of Muritala Mohammed International Airport. You can see the story. This is just a story. Where they're actually going, you see it there. But you just read it so that you can see the content. On May 25, 2006, as Chief Shipazam was in the executive lounge of Muritala Mohammed International Airport, Lagos, awaiting departure, he met his longtime friend and business colleague, Chief Roger McKinsey, who is also an entrepreneur. During their discussion, Chief McKinsey wanted to know how beneficial it would be to him should he decide to invest in Ethiopia. His areas of concern are mainly companies and assuming he decided to start an African airline business in Ethiopia. Meanwhile, the financial result of Obi Airlines Limited for the year that 2015 as follows. Shown below. Let's look at income from passenger flights on other routes. 213,686,750. Income from cargo loaded into aircraft on other routes. Can see 218. Income from passenger flights from Nigeria. Can you see from Nigeria now? That means that those loading are made from Nigeria. That's more of Nigerian income. Income from cargo into aircraft from Nigeria. Again, that's 49,938. Everything is 536,288,205. These are all the obviously, this is global income. Because this is the income from all this what activity globally. Look at their deduction, global deduction. The deducted salary to be this, general provision to be this, and other expenses to be this. If you remove it, you have what? If you remove it from the global income, you have 519, 145, and 149. 519 million, 145,000, 149. Now, that's net profit. Additional information included the following. 1. Capital allowance will agree with the relevant authority at 110% of the depreciation charged. Now, this happens to be a deviation from that ratio that we computed. You know, in the ratios that I gave you, I told you compute adjusted profit ratio, you also compute depreciation ratio. But in this case now, there won't be any need for you to compute depreciation ratio, because in this exam now, they say the capital allowance that was agreed by the two tax authority with the relevant authority at what? 100% of the depreciation charge. It means that whatever the depreciation they charge, 110% of that depreciation will be the capital allowance. That is that there won't be any need for you to compute the depreciation, the capital allowance or the depreciation ratio. We will do it to divide by what the global income tax 100 again, because you just increase the depreciation by what by 10%. That's 110% depreciation will be what the capital allowance. No. As a tax consultant, you are required to prepare computation showing total profit of OB Airlines Limited from Nigeria to Nigerian tax for Nigeria tax purpose. For Nigeria tax purpose, how much you pay as tax liability? What's total profit as far as the Nigerian tax purpose is concerned? Company income tax liability for the relevant year of assessment. What's the tax liability? You have to determine the profit, the tax liability, and even the tertiary education tax liabilities. I hope you understand what I'm saying now. Now, if that's the case, now the tax liability. Now, I told you, in the first thing to identify what's your global income. That's all the income they make both in Nigeria and outside Nigeria. And if you look at this question very well, their global income should be what? 36, 288, and 205. That will be the global income. So in this instance, my global income is 536, 288, and 205. That's the income they make both in Nigeria and outside Nigeria. I hope you understand what I'm saying now. Now, if that's the income they make, they call it what? Global income. Now, you now need to go and get what is Nigeria income. Please, the examiner is always tricky when they get to this area. They will use their grammar or English to want to confuse you. I get what I'm saying now. If they say they move the goods, they move passenger from Ethiopia and route Nigeria to US. Will you not see that Nigeria income? Someone should tell me, is it Nigeria income or not? They move goods and human beings from Ethiopia and route Nigeria to US. Is it Nigeria income? Someone should tell me, is that Nigeria income or not? When they say they move goods or a human being, through air from Ethiopia and route Nigeria to US, can you tell that as Nigeria income? Thank you. Thank you, Justina. It is not Nigeria income because that transaction was not, they didn't commence the transaction from Nigeria. You're actually coming from somewhere, you just stop over in Nigeria and move to US. That's the way you look at it. It is only the transaction that moves from Nigeria to outside Nigeria that you return, the income from there that you term Nigeria income. Look at it. If you look at the question very well, you will see what is the Nigeria income here. You can see the Nigeria income from passenger flight on another route. This is on another route. This is not Nigeria. Income from a cargo loaded into aircraft on the other route in Nigeria. But income from passenger flight from Nigeria. This is actually originating from Nigeria. That's also Nigerian income. Income from cargo loaded into aircraft from Nigeria. That means that's also Nigeria income. If you add the two together, that will give you Nigeria income. So the Nigeria income now, you know, the income from passenger flight from Nigeria is 4 billion. Income from cargo loaded into aircraft in Nigeria is 49. If you add it together, total Nigeria income is 104 million 339 and 455. With that, I already need to identify my global income, and I also identify my Nigerian income. Therefore, I need to now get the global adjusted profit. Now, to get the global adjusted profit now, what do I do? I will now go into the question. If you look at it, and this is the profit. This was the profit, 590,145. But for this profit, there are some expenses that they have removed that are not supposed to have been removed. Those expenses now, you need to add it back to that profit so that you can get adjusted, global adjusted profit. I hope I get it now. You know, say net profit is 591.45. Is desirable. Is a desirable item. Tax salary is also allowed because you have to pay salary. General provision for doubtful debt is disallowed. As far as tax authority is concerned, when it's a general provision for doubtful debt, they will know what they will not allow it. They will not allow it as an expense because the one they allow it specific. How will you tell me that the amount of your provision is 10% of your receivables? It means that if your receivable is 100 billion, you say 10% of 100 billion, you want to remove as an expense, they will not allow you. They will only allow you if you can be specific of that provision that we make a provisions of this amount, 10,000 or 100,000 or what debt that is down, that what that their collectability is what is indulged. That's when they can say you should allow it. Therefore, this general provision is non-allowable expense, not taxable, non-allowable expense. But other expenses, fine, allowed. Therefore, I would now need to identify my generation. That too, I will need to add it back. I will need to add it back to my work, to the profit. Can you see? Depreciation and general provision. The other expenses in this instance, well, you know, it's a subjective thing. When you say other expenses, I hope I get what I'm saying now. It can either be here or there, not there. But in their own computation, there is allowed. Therefore, so in the exam, when you say other expenses and they did not expatiate on it, they should be clear on it. If there's other expenses, whether it's allowed or not allowed. But in this instance, just know that for you to know whether expense is allowed, allowable expense or not, it needs to follow the test. You need to pass the test of what only reasonably, necessarily, and exclusive for the business. That's REN, W-R-E-N. I hope I can see them. So in this instance, other expenses are what are allowed. So the only one that are allowed are the staff salaries. So addition of this now, you add it back to the net profit. You now have adjusted profit. I hope I get what I'm saying. Now, if you now have adjusted profit, now, if you now have the adjusted profit. Now, the adjusted profit was how much? 521,759,324. We will now go back. What is now adjusted profit ratio? And to get the adjusted profit ratio, it will be determined by saying adjusted profit over what? Over global income times 100 over 1. They should have featured that in the words in the notes or in the workings. Look at it. Look at it. Workings, notes. Computation of adjusted profit ratios is global adjusted profits over global income times 100 over 1. Adjusted profit that will go of 536 to 204. Let me confirm that figure. adjusted profit is what? Is 521,759,324. It is 521. Why the global income is 536? You can understand. The adjusted profit was 521. Why global income is 536? Therefore, if you now come here now, it should be 521 over 536. Sorry, that was a mistake. I get it now. The adjusted profit was 521,759,320. Why the global income was 536,288. So it means that instead of to be 536 over 521, it should be 521 over 536. Please, sorry for that. So if you divide that and multiply by 100, you have what? 97.29%. I hope you are getting what I'm saying now. Now, if it's 97.29%, then what do you now do? Look at it. You now go back to the look at it. I said adjusted profit now. What's adjusted profit? Adjusted profit is now the global adjusted profit ratio we got, which was 97.29%. You now multiply it by what? By the Nigerian income. What was the Nigerian income? Can you see Nigerian income? That's 104,339,455. Now, if you now say 97.29%, which is this is what adjusted Nigeria what? Nigeria income, that will give us what? The accessible what? The accessible profit. Now, after getting the accessible profit, what next? You now less your what? Your capital allowance. Now, you know, in the question, you are told that for you to determine your capital allowance, it should be 110% of what? Of depreciation charge. And if you look at the depreciation charge, you just get 1,974,125. If I find 110% of 1,975,125, you can use your calculator on this. Let me use my own calculator also. It means that you will just say 1.1. Look at it. You just say 110% is 1.1 of that value. 1.1 and that value. 1.1 times 1974125. 1974125. That will be 2171537. 2171537.5. That's 537.8. That will now be my capital allowance. So it means that my capital allowance now will now be of the mentioned person. And 110% of that depreciation mentioned was 1.974, 1,974,125 times 1.1. It will give me 2,171,538. That will be my capital allowance I'm going to subject to determine the total profit. If I move it from 101511856, I'm going to get a total profit of what? Of 99,340,318. 99,340,318. If that's the case, that means that the total profit that is liable to tax in Nigeria is now what? Is now 99,340,318. Now, if that's the case, that happens to be the first thing you are asked to what? You are asked to do. Are you getting what I'm saying now? So let us now go ahead and do the next one. What's the next thing they ask us to do? If you look at the question, they ask us to compute the company income tax liability for the relevant year of assessment. What's that company income tax liability now? You now go back to the profit taxable in Nigeria, which is 99,340. Look at it. Computation. Company income tax liability for 2016 assessment year will be 30% of that profit. 30% of 99,340,218 is now what? 29,802,095,040. I mean 40. That happens to be the tax liability to be what? To be paid to what? To Nigerian government. I hope you understand the way we arrive at this this tax liability. Now, after doing that, now let us now look at it. We now compute the minimum tax. What's not the minimum tax? I told that the minimum tax that you want for company for airline is what 2% of Nigerian income. And if you go and look at it, what was the Nigerian income in the question? If you look at Nigerian income, they'll give you the Nigerian income is 104,339,455. Just find the 2% of it. The 2% of it. You now say 2% of that Nigerian income will give you 2,086,789.10. That is the minimum tax. They cannot pay less than that amount to Nigerian government. So you now compare these 2 million now. You compare it to the tax liability as computed for that company. Now, the higher of the two is what will be paying tax to Nigerian government. And the higher of this two is 29,802,095.40. Now look at it. Therefore, company income tax payable for 2016 year of assessment in Nigeria what is 29,095.40, which is the higher of the two. That's how much they will pay in tax to Nigerian government, since it is higher than the minimum tax. I hope you understand what I'm saying now. So the minimum tax liability, the amount that they are going to pay to government, which is higher of the minimum tax, and the amount what is 29 million pay in tax. Now, therefore, company income tax payable for 2016 is what? Is this 29 million? I get me. Now, and the tertiary education tax is new, but they have to compute the tertiary education tax. Now, let us see the reason why it is new. At the provision of section 1, section 2 of the tertiary education tax fund, establishment, etc., Act 2011, the company is not liable to tertiary education tax if it is a non-resident company. It means that it's a non-resident company, therefore it is not what? It is not taxable in Nigeria. Tertiary education tax is payable only by companies registered in Nigeria. I get me. That also is caused under the what? Under the digital economy and based on profit shifting. I mean, under the digital economy. I get what I'm saying now. So that is that for this. Now, what is not the, what do you have as a takeaway from this topic now? Takeaway from this topic is that what if you are given airline, shipping, courier, telecommunication to resolve in the exam. Please note that the way you do each of them was they are all the same. You are going to treat them the same way. And now you're going to treat them, one, you determine the global income, that's all the income they receive both Nigeria and outside Nigeria. Two, you determine the Nigerian income, that's the income they make from Nigeria outside to outside Nigeria. Three, you determine the global adjusted profit by adjusting the what? The profit of the business, adding back desirable expenses. Four, you determine the global adjusted profit ratio by dividing the global adjusted profit by the global income and multiply by 100, get the global adjusted profit ratio. 5, you determine the depreciation ratio by dividing the depreciation of the company by the global income to get the depreciation ratio. 6, you now determine how much is the amount of profit that is liable to tax in Nigeria. How do you say that's a simple profit? By what? By multiplying the global adjusted profit ratio by what? By the Nigerian income to get the profit, and by what? Multiplying the depreciation ratio by what? By the Nigerian income again to get the capital. Same profits. Where you less your capital allowance, I get what I'm saying. Where you determine your total profit, you less the capital allowance from what? From the profit to get the total profit. Total profit you multiply by 30%, get the tax liability, and you multiply you now compare with 2% of what the Nigerian income to get the minimum tax. Now the higher of that minimum tax and the tax liability as computed by you is now what you make as your tax. Oh, my voice is breaking. Oh, wait. Okay, can you hear me now, please? Carlo, can you hear me now? internet is unstable. Oh, thank you. Thank you. Now, so that is that. Now, let me explain. I've seen a question in the last 10 diet also that the examiners expressed their questions in terms of minutes. I get what I'm saying now? They express in terms of, if you look at your past question, I think in 2018 or thereabouts, they express the question in terms of minutes. Look at what they did. Sorry, I was able to load the questions. Look at it like this income from passenger flights on other routes. They will say the number of minutes for income for passenger to move from other routes. They will put the minute here. Income from cargo loaded into aircraft on other routes. They put the minute. I mean, that just they express it in minutes. They also say the minutes. I mean, from passenger flight from Nigeria, they put the number of minutes it takes them, and also the last one they put the minutes, and they give the total minutes. And that minute now, they now told you how much. In fact, they did it for telecom. Yeah, in that question, I think they now convert. They now told them in the question the rate at which they pay for 1 minute. I hope I get what I'm saying now. That means that if they are given in minutes, it is common sense for us to look at it that if this is in minutes, I need it in naira. And I was told that this is the amount they are paying for 1 minute. Assuming this 230 million is the 230 million minutes, and they pay 50 kobo per minute, what will happen? What will now be the value here? You now be 230 million minutes times what times 50 kobo. That will be the value you place there. And you now compute your computation, and you now do your computation normally. Now get me now. I've seen that before. That was in I think 2016 or 17, thereabout. They asked this question in minutes. Either they do it in minutes or in hours, or they will give the conversion rate. That conversion rate is what you multiply by that minute and get your value, and now compute your normal, go by your normal steps. I hope I get what I'm saying now. That is very instructive. I hope I get me. That's very instructive because I've seen that. I mean, the 3 times they set it in the last 10 days, one of that 3 times they set it in terms of minutes. And the student asked me that, what do we do in this instance? I said, okay, you just convert it to give you the rate of conversion. So I would like you to also go through those past questions. You will see what I'm saying. Apart from that, I've not seen them asking it any other way, right? Thank you for listening. I told you that I have to interject this class. I'm so sorry. I'm so sorry for 10 minutes. I get what I'm saying now. For 10 minutes, you have to give me so that I can upload, I can receive and upload the insurance. I thought I'll be doing mining and this topics today. I know this will not take me more than 1 hour. I get me, but I realized that we had a competition program with my colleague that that particular topic I've been taking already. I get you realize what I sent to you. You see there that we had the mining taxations in there. I get me now. So please, I'm sorry, 10 minutes. You have to give me my host, sir. Please, I have to log out 10 minutes, please.
All right, sir.
Okay, thank you so much. 10 minutes, please.
No, that's for me to talk.
Then you are the
I'm sorry for this for the break in the. Yeah, my host, I hope you can see me, sir. You can hear me, sir.
Yes, sir.
Okay, thank you. Okay, I'm so sorry once again for the time. I'm sorry. Um, just have to. I'm so sorry for that, please. Sorry. Now, the one we just finished now, it happened to be the airline, and you know, it's a specialized. These are special business, and this is another one. Please, why I have to take my time to actually take this insurance is because most of the centers they will not take it. They say it's a bit clumsy. Throughout the 10 diets, the last 10 diets, the examiner did not touch this insurance, taxation of insurance. Sorry, so sorry. Taxation of this insurance company, they never touched it. So it's what about if they now come around to to bring it now as number one question? So how do we handle it? Now, please let me sound that insurance company is a very sensitive company that they have their peculiarities. Now, I'm a chartered accountant. I'm not an insurance person. So, to our best of knowledge, we'll exude what we have here to our best of knowledge, and just to help us to want to move to the next level. That's why I mentioned they said this question. So there are some technicalities or jargon in it that ordinarily are what the full knowledge of it are best known to what to those people that are on the field. I hope you're getting me. I'm not trying to renege on what is needed to be done. I mean, I'm not saying we will not do what's needed to do, but I'm just saying for the insurance company, they have their technicalities, and that's what part of it what they played out in their top in this topic. So please, to my best of knowledge, I will exude what we have here. So for the insurance companies, let us manage the situation, the space. Now we have a life insurance, we have a non-life insurance, and we can also have insurance business. I hope you're getting me now. The life insurance, you can also call it assurance anyway. That's when you what when you where you are talking about the insurance or insuring of the life of of an individual. I get you now against death. It's inevitable. It's just a matter of time. It will come one day, but it's a matter of time. So when an insurance, when an individual now go for what will have a policy, an insurance policy, I mean, to ensure his life. I mean, so that at the end of his death. Sorry, I'm actually I'm sorry. Sorry. Now, so that you can ensure his life. Now, if he's insuring his life, I mean, so that his beneficiary or his estate will take the benefit. I mean, it's the benefit at the end of the world at his demise. Then that's what we call what the life assurance, or we call it assurance, life assurance. You can also have non-life. That's when you are not insuring against what? Against your life. I get what I'm saying, just against property or other items, right? You know, maybe you're insuring against a burglary or, I mean, accidents, I mean, thief and all that. So if you are insuring your property against that, or your items against that, not life, but non-life, that kind of insurance that was found under the non-life insurance business. Now, apart Mouse, can you hear me, sir?
Yeah, very clearly now.
Can you hear me?
Sir.
It's still low.
Very clearly. Go ahead.
Can you hear me now?
Yes, very clearly. Go ahead, sir.
Yes, okay, thank you. Sorry. But now, so as I was saying, we have an insurance, a life insurance, non-life insurance, and reinsurance business. Now, let's quickly look at life insurance. Now, let me explain that this particular topic is a format driven. In the exam, my take in the exam is that they can set this particular question as number one question. I get what I'm saying now. Yes, I expected them to have set it, but they have not. They can set it. Now look at it. Taxation of insurance business. Now, determination of accessible profit from life insurance. Assuming the question you are given is actually life insurance business. Now, how do you determine the tax liability of that kind of what of that kind of company when they are dealing with what insuring the life of what of an individual? I guess what I'm saying now. What is the way to how do you determine their income? How do we determine their tax liability? Please, number one thing I will need to let you know, if you are solving a question of life insurance in an exam, you need to note that for life insurance, any premium received by life insurance company will not be counted as their what? As their income for tax liability purpose. Let me sound it again. You know what the insured is paying for that insurance policy is holding with what with that particular company is what supposed to be an income in the hands of what of that insurance company. Let's say, for instance, I insured my life with Mansard Insurance, and I insured my life, and it means I need to be paying a certain amount at a periodic interval, which is my premium. Now, for tax liability purpose of what of Mansard Insurance, that particular premium we are paying them will not be counted as an income to them for the purpose of tax liability. Also, whenever there is any claim, matter what they insured again now happen. I get him now. I mean, the person that they insured again, maybe the person now eventually died, and they need to pay the family of the what of that deceased. I get him. What exactly is what is left in that policy to that what as a compensation? That compensation also, which is termed as a claim, will not also be taken as an expense in the hands of the Mansard Insurance because they are life insurance company. Which simply means that in the exam, when they give you life insurance company or life insurance company, so to say, the premium will not be taken as an income and the claims will not be taken as an expense. You should ignore it in the exam. But if you now go to non-life insurance or reinsurance, it's possible that I insure my house against theft or I insure my car against accident, and it's possible I don't have the accident or there is no burglar, there is no theft. What happened at the end of the day? It simply means that it's possible I don't pay the claim. If that thing that they insure again did not happen under the non-life, that simply means that what and it's possible that what it happens. Are you getting me now? So in what it means that there will be what in non-life insurance, the premium will be deemed to be what to be received as a revenue
as what? As an income, why the what? The claims will be seen as an expense. I get it now. Why it will not be so under the life insurance is because if you insure your life, the what once you insure again will surely happen. That is that what is received as premium will always be paid as what? As a claim. That is why those premium and the claim will not be taken care of in the company's income and expense for the purpose of tax liability of both of the life insurance company. But for the non-life insurance company, the premium is an income, the claim is an expense, and for the insurance also. Please note that. So in a nutshell, if you look at the format of a life insurance, you know, insurance companies are institutional investors in which the returns, the premium that the policy holders are giving them are used to what? To invest in what? In short term, in long term securities, in the money market, in capital market, and so on and so forth. Now, if they invest this money, they will get returns. These are investment income. Therefore, the income to them, you now turn it to the what? Investment income. Look at it. All the income, like dividends, interest, all this income from that investment is investment income. That's their income. The next one is actuarial evaluation surplus. That's also what? An income to them. You know, when you want to go for insurance policy, there's a way they will value the life of that person, the life insurance. It's such a way that they want to know what's the remaining life of the estimated life remaining of this life, of the life of this person. So that at the end of the day, at the end of every year, they want to know whether they are having a surplus on your policy or not. That surplus now is your actuarial evaluation surplus. That if they do the actuarial evaluation and they realize that there is a surplus, I get me, that surplus now, they will give you the question, is an income to them. Also, other income, they put other income there, take it as an income. Therefore, for the life insurance company, the investment income, that's the income from their investment activities. Other income as stated in the question, also any actuarial evaluation surplus will be added together to give you their gross income. Now, after getting their gross income, you now deduct the following. Look at the way they deduct their expenses. What you are deducting is divided into three parts. The first part, the second part, the third part. The first one is what? You go and check. They will give you in their statement of financial position the general results of the company. Pick it. General results. You now say add life fund accounts. You know, this is the life fund account, not life fund accumulated. Life fund account. You see, the life fund accounts. Now, when I Google and I got the information, the life fund account is that account in which the payments, the claims will be paid out from. That's the account in which the payments for that claims you want to make at the end of the day when that what they insured against that happen. That account will be what? The account is the life fund account. Now, the balance of that account, add it to the general reserve of the company. Whatever you get, you now get net liabilities on policies. Net liabilities on what? On policies. You know, the policies that people are having with them. If you have policy with an insurance company, a life insurance for that matter, there is a way they revalue their policy, the policies they have at the end of the year, in which they will know whether they're having a surplus or what, or liabilities on that policy. Whether they are owing on that policy. Whether, you know, the way they do that is for them. They do that. The actual insurance does that. Therefore, if they give you the question that there is a net liabilities on the policies they are having with them, that people will have less it from the addition of the general reserves and the life fund account. You know, when they did the actual evaluation surplus the other time, the surplus was added as an income. But any liabilities on their policy will be deducted here. I hope I get what I'm saying now. From the addition of their what? Their reserves and the life fund account. If you add that, the addition of that is this. I hope you're getting that now. The addition of that is this. Now, after doing that, let's say we have that here. Because you can see, liabilities on policy, if you less that from that, you have this value. Now, you now go to the second one. Sorry. The second one is what? The second thing they are deducting is what? Is special reserve. After you have, the first one is general reserve, add life fund account, less net liabilities on policy. All this information will be supplied in the question. The special reserve, to get how much is transferred to the special reserve of that life insurance company. I get me now. Because that amount you are transferring will be deemed to be what? To be expense. I get me in their profit statement. To get that reserve you are transferring for every year, it will be the higher of their the higher of 1% of gross premium. What's the total premium they receive? The total premium they receive, 1% of it. I get what I'm saying. That you identify the 1%. You now say again, 10% of the net profit of that business for that year. What's their net profit? 10% of it. The higher of the 1% of their gross premium and 10% of their net profit, the higher of it is what you will pick to be what? To be an expense. Can you now see? The addition of this and less the net liability on policy, you pick it, assuming this item is here. Now, the higher of the gross premium and net profit, the higher of it is there, making 2. You now say, the third one, the third expense you are removing is what? Other management, allowable management expenses. Please note, so there will be some other expenses they will give in that question. Those expenses, they are not, it's not all of these expenses that will be allowed. It is only the one management expense that you, and it must be allowable. I hope you know the meaning of allowable. If you put depreciation there, don't take depreciation. It's not allowable expense. So you now identify those allowable expenses there. Management expense, you identify it. If you now add all this, the value here, the special reserve, the one you pick out of this higher 1% and 10%, and this management expenses, if you add the three together and less it from this gross income, what you get is this. That's accessible profit. Now, to the accessible profit, you now go and less the capital allowance. What you now get is their total profit for life insurance. Now, the total profit is this now. What is now the tax liabilities of this what? The tax liability that you're going to pay will now be 30%. I mean, will now be what? 30% of this profits or 20% of the gross income. I hope you know the meaning of gross income. This is their gross income. Can you see their gross income? This gross income. 20% of that gross income and 30% of the total profits. The higher of the two is what they are paying in tax to government. It means that what the life insurance company is paying to government in tax will be 30% of the profit or 20% of the gross income, the higher of the two. That is all about the life insurance tax liability. How do you determine this? You say the investment income, other income, actual evaluation surplus, add it together, you get their total income or gross income. There are 3 things you are lessening. General reserve, add life fund account, less net liabilities on policies, you get a value. Special reserve, higher of 1% of gross premium or 10% of net profit, you add the value. Also, other allowable management expenses, you add the value. Add the 3 together, next from gross income, you get the accessible profits. Less capital allowance for accessible profits, you get the total profit. And tax total profit by what? By 30%. Whatever you get, you compare with 20% of their gross income. What you get as the higher of the two is what you pay in tax. Now, but if that life insurance business is not a Nigerian company, it's a foreign company, there is a deviation a bit of how you're going to determine the tax liability. How do you determine it? You determine what's their investment income. That if it's an insurance, if it was a foreign company, you first determine what's an investment income. This investment income now, you know, the way you get investment income, you go and do it the way we do airline now. You want to see what is the proportion of the investment income that they make in Nigeria. So far, it's not a Nigerian company. Therefore, to get that investment, that's why we put working one there. You know, say, what's the premium they receive in Nigeria over their global premium? How much is the premium they receive in Nigeria over all the premium they receive all over the world? Then multiply it by their global investment income. Whatever you get is that income or investment income that is attributable to Nigerian business. Then you now left agency commission in Nigeria. As we are operating through agency in Nigeria. The commission they are paying to the agent is what? Is allowable expenses. Other allowable expenses in Nigeria and proportion of the head office expense, they will give it to you. That proportion of head office expense, you add it to all this, you less it, whatever you get is your accessible assessable profit, and that's what you are taxing in Nigeria 30%. I hope that is clear. That is for life insurance business. In case what the company is not a Nigerian company. That is that. Now, if you now go to the format of the non-life, you know, the other day I told you that premium and claims under the life insurance will not be an income and expense respectively. Because what we insured against will surely happen. That means that the premium and claims will not be what? Will not be taken care of in the life insurance business. But under the non-life insurance business, part of their income should be the premium. I hope I get what I'm saying. And part of their expense should be the claims. Look at it. Look at it. The premium they receive, gross premium is this. If that non-life insurance is now having a reinsurance business, it means that part of the premium you receive, you have to give it towards the reinsurance. It means that whenever they are going to pay claim also, that reinsurance company will pay part of the claim to the extent of the proportion of the what? Of that premium you receive initially. I hope you get what I'm saying now. That simply means that if there is a reinsurance situation under this non-life, the gross premium, unless how much is paid back to the reinsurance business, what is left is what is the net premium in their hand. Note. But if there is no reinsurance, that means that your gross premium is their net premium. Please notice. You now add interest income, whether they have an investment or whatever, and there's an interest income, they will list it for you. Other income, if they set it in the question, they put it. You know, it means that they will invest, right? Those investment income is also has to be added together to the what? To their net premium. If you now add all these three together, what you get is your gross income. Can you now see the difference between that and the what? Okay. And no, I will give you. Tokwe Sonny, I will give you. It's because, you know, someone was typing it, and because of that logistic issues, it took time for them to say. That's why, as I sent it to me, that's why I actually uploaded it. But immediately I'm done now. In the next 1 minute, I finish this. I'll send it to the group. I'm so sorry for that, please. Sorry. Thank you. Now look at it. So these are their income, right? This is the gross income. Now, if after getting their income, you can see the difference between this and the life insurance. The way you do this thing is you'll be making comparison between life and non-life. Look at the life. Look at their income. Their income is investment income, other income, actual evaluation surplus. Do you see any premium there? No premium. So it means that premium will not be under the life, but under the non-life. But under the non-life, you will see premium. That's why you see premium here under the non-life. Thank you. Now, after you've gotten the gross income, you now less. What are you going to less? You now less provision for unexpired risk carry forward. You see, there is a way the insurance company, non-insurance company, they make a provision for the risk that has not expired at the end of the year. You know, those policy holders, they will just have a policy in your company, but there is a way you make a provision for those risks that you are exposed to that have not expired. I guess at the end of the day, you know, because you know whether you like it or not, insurance is a risky business. I get what I'm saying now. If someone insured against accident, and as of this year, no accident has actually occurred, is there not? Will you not make a provision for that risk that have not expired, and it's going to last for maybe 3 or 4 years? This is just the first year. Make a provision for it. That provision now, you can see, less provision for unexpired risk. They will give you a broad forward from last year. No, you will not take the one brought forward. It is the provision for unexpired risk that is going to be carried forward. That's what you're going to pick. If you pick it, now you are not going to deduct it directly like that. You have to compare it to any of these. You need to restrict it to what? 45% of total premium in case it is a general insurance. It means that you need, as me the question is a general insurance. If it is general insurance, I know it will not be a cargo marine. If it is a cargo, it will not be a general. A general insurance business, 45% of the total premium, if you compute it, You will now compare with this provision for unexpired carry forward. The lower of the two is what you are going to expense. But if the question is saying the insurance, the non-insurance business is a cargo marine, it's for cargo, I guess what I'm saying now. Now on the water. Now it means that what you are going to compute is 25% of total premium. That's what you are going to compare with this unexpired risk carry forward. The lower of the two, not the higher. The lower of the two is what you are going to expense. Therefore, assuming the unexpired risk carry forward was 100,000, and the question is on general, and 45% of what of the general of the total premium is what 80,000. Which one is higher between 80 and 100? That's 80. You're going to less 80,000 here. 80,000, you're going to less it from here. You have this value. Now, after you less it, you now go back here. You now go and say less allowable expense. Now, your allowable expense now, the one you start with now is that claims. You know, here, under the lives the other time, you know, we said under the expense, so general research and allowable, under the allowable expense, do you see any claims there? No. Now, if you now come here, you can now see the allowable expense here. The allowable expense, you now be less claims from which. Now, what is the claims? This is the claims now. It's an expense. But that claims now, you now go and deduct the claims that will now be payable by the reinsurance company. Because when you collect the premium the other time, the premium was also what? Also be shared by what? With the reinsurance company. Therefore, whenever there is a claim, that claim will also be what? Will also be paid or shared in proportion of the what to the what to the way they share the premium. Therefore, whatever the claim they are paying by the insurance, you will less it from the total claim. The balance is this. That's one. Two, any commission paid, maybe they are to their agent or their whatever, they will take it, add it. Other allowable management expenses, not depreciation, not allowable. Other allowable management expenses, the rent, everything, allowable management expenses, add it to this. The addition of the three now, this is it. Now, you will not now remove the addition also, directly like that. If this addition is 100,000, let's assume, you now go and look at 25% of total premium again. What is the 25% of the total premium of the world of the non-life insurance business? You now compare it with this addition of this allowable expense. If addition of the allowable expense is 100,000, and the 25% of total premium is 80,000, which one is lower between the two? 80,000. It is the lower between this all addition of the allowable expense and the 25% of the total premium that you are going to less as an expense. Can you see the expense now? Can you see why they say it's a special business? If I now less this expense from this, and now have accessible profit. That accessible profit now, I less my capital allowance, I have my total profit. The total profit now, I will now say, what's 30% of total profits? That's what I'll pay in tax. I will now compare with 15% of their gross income. The higher of the two is what I'm paying in tax. I hope you're getting me now. That is for non-life insurance. It's very key. So in the exam, I expected them to set it in number 1 question last exam, but they did not bring it because of their question. They put in their pack. So for non-Nigerian company, where a non-Nigerian company engaged in non-life insurance business in Nigeria, the accessible profit will be determined just like that of the Nigerian company. So if it's a non-Nigerian company, you will determine it based on what, like the way you have it at a what, like non-Nigerian, like a Nigerian company. However, only premium received in Nigeria will be taken into consideration. So what we'll be careful of, whether the non-Nigerian company, you do the same way we do this, but only the premium you receive in Nigeria you will take care of. Also, only expenses incurred in Nigeria will be allowed as deduction, including the proportion of the head office expenses. So expenses that you allow is only Nigerian expenses plus what a proportion of the what of the head office expenses. So you need to what? You need to understand the formula. If you check your pack, you see them there. I get what I'm saying now. Now the next one is the reinsurance business. It's the same thing with the non-life insurance business. The same thing. Nothing changed. But there is only one caveat there. Look at it. For the insurance business, gross premium, less premium insurance, like the way we have it, you have the net premium, add interest income, other income, gross income, less premium, like the way we have it. Up to this point, I get me now, up to these allowable management expenses. Now, when you now get allowable management expenses here, we say the claims, less claim to the insurance. As me, those ones too is also having a reinsurance business also. Less claim to the insurance. You have this add commissions and other allowable expenses, you have management expenses. This one now, you now compare with 20% of total premium. You now pick the what? The lower. Now, in the other one, non-life, we just remove this one from this to get the what? Adjustable profits before we less capital allowance. But in this one, you now what? You now do extra thing. These are the extra things you do here. The first one is you now want to make a transfer to a general reserve. We now want is how much are we going to make a transfer? How much are we make a transfer to general reserve? Because that transfer to general reserve will be termed to be an expense. Look at it. You now compare in the question. Compare the general reserve in the question to the minimum authorized share capital in the question. They will give you everything. If the general reserve is less than the share capital of the company, what you are going to transfer is 50% of the gross profit in the question. Profit, too, they will give you profit in that question. 50% of the profit is what you transfer as your transfer to general reserve. But if your general reserve is more than the minimum authorized share capital, what you are transferring is 25% of your gross profit. That's the only thing that is changing there. Now, 50% of gross profit, 25% of gross profit, whichever the case, either general reserve is less than or more than the minimum share capital, that's what you are going to what you are going to less as part of the expenses. Before you now get adjustable profit, less capital allowance and less and what are total profits, and you now compute your tax liability, which should be 30% of this profit or 15% of the gross income, the one that is higher. That is all. That's all they want you to know as the format for what? For life, non-life, and what? And reinsurance. Now, in the exam, they can give it as number one question. Look at the question they will likely give you. They will just change the name. I'm telling you, it's in your pack. Equal Insurance Company. They use another name in your pack. This is the question. You can see the question. This is the question they will give you in the what? Likely give you in the exam for you to do. I get what I'm saying now. If they give you this now, they will not. You can see the question. This is the question. They will now ask you to what? Look at the requirements of the question. They now say compute the company's tax liability for the relevant tax year. It means that you will compute for life because that question is actually what? Life, non-life, and what? And reinsurance business. Life, non-life, and reinsurance business. You can see. It's life, non-life, and reinsurance business. So that is that. So what we now need to do is to now pick those items. I will now resolve the question. But unfortunately, this is the level on dot. Now officially, this advanced tax, as far as to me, is supposed to be the end of the class, but this happens to be the 4th week. But I will have to see hold the class with you. I will try to hold the class with you to see if we can see hold the class so that we can resolve what we can resolve. We can resolve this question and what I also talk about other things generally in the syllabus. So I will try as much as possible by tomorrow. I hope I get what I'm saying now. So to give you a time of when we're going to meet on weekend. I guess what I'm saying now, it will likely be on weekend in the evening. Either Saturday or Sunday. Please bear with us so that we can put it to a logical conclusion. I want to give that one extra class. I guess what I'm saying now, so that we can give it to logic. Incentives, no problem. Talk personally, no problem. I will try. I will try to talk about the incentives, please. No problem. I'll put it under focus. Thank you so much. I'll communicate to you by God's way by tomorrow latest of when we're going to meet on weekend. Thank you. I pray by God's grace that this exam will be a done deal. You will not repeat this. You're going to pass this exam. I'm going to be a qualified chartered accountant in this diet that is coming. Please start reading. They will soon announce the date soonest. Have a good night, friends. Thank you for the problem we had. I had the little itch I have today. I'm so sorry. So sorry. Thank you so much. I appreciate you guys.
Thank you. Have a good night, rest. Thank you. Thank you, my host, please. Thank you, sir.